Well, thank you for the introduction, which I didn't really hear, but I hasten to add that this was not constructed to refute Darrell Duffy's lecture of last week. It was in fact constructed much earlier, but I mean, in a sense, it is a bit of counterpoint. And when it was announced, Darrell immediately sent me an email saying, I hope you're going to send me the slides. So he gave a beautiful, actually, microeconomic theory of over-the-counter derivative search by clients. And I'm going to try and say something about what clients actually see. It's quite a long way from the theory, as you will see. This is based on expert witness work over the last 7 years. In fact, I was working on something this morning in this, so it's certainly continuing, and it seems, if anything, to be getting worse in this country. It's calming down in Germany. But it started much earlier, and the judicial system has, I think, a better view of how clients have been disadvantaged because of the case record to date. So let's get started. Sometimes I put a query on that. I've given this talk a few times before, most recently, I think, in Amsterdam at the Wharton, Cambridge, Erasmus tripartite workshop, which we have each year. And I think I had a query on it then, but I mean, really the query is a bit facetious because I have no doubt in my mind at all what the true cost is, and I'm going to try and convince you as follows. Oops, wrong button. This is what I want to convince you is not the case. These are two quotes, one from former US Treasury Secretary, Harvard President, now a senior advisor to Citigroup, Larry Summers, and the other, Martin Jacob, who was Chancellor of Buckingham University in this country and is chairman of Share PLC, about the Glass-Steagall Act. In 1998, when they were about to repeal it, Larry Summers said it's an archaic set of restrictions. This, of course, separates investment banking from commercial banking, which means that investment bankers have to have some skin in the game, basically. And that's why investment banks, while they were profitable, they weren't excessively profitable from 1933 on, basically. Even Goldman Sachs, while they made good profits, they didn't make excessive profits, so to speak. And Morgan Stanley, of course, also. In fact, Morgan Stanley is a creation of the Glass-Steagall Act because it was hived off J.P. Morgan, which is now its rival as an investment bank as well. So what I wish to convince you no longer exists is this quote, that the Glass-Steagall Act was introduced to deal with a problem that no longer exists. Note that stress, the distribution of fraudulent securities to uninformed customers. Well, fraudulent, of course, is a legal definition, but uninformed customers is certainly the case. And these problems with derivatives go back a long way. This is a cartoon from the New Yorker in 1937 that's before options were valued, which says that you can do anything with an option, and the man is just puzzled by all the possibilities. So I'm going to say something about the background for the growth of derivative trading, and then what the role of structured OTC derivatives are from various points of view. And then I'm going to get into actual experience. And if I have time, which I hope I do, I'll say a little bit about our pricing methodology, and then a little bit about evolving regulation of over-the-counter derivatives, from which I have to say I learned some interesting things, and you all did, from Darrell Duffy last week. And I now see that the stuff that you can see what he was talking about in the data. Okay, so I'm going to start in 1980 because really serious derivative trading, option trading, of course, started in the early 70s. It was first in equities, and then it went to foreign exchange. And then it took a long time to really start going on fixed income, on rates derivatives, because that required a swap, and the swap only really started, well, I'll show you this in a minute. But in this, so that's the period 1980 to the crisis. In this period, there were huge technical changes. I'm not going to read these slides. I mean, I think I just try to speak to them, and you know, if you want to look at the details, they're there. Huge technical changes: data, mathematical and computer calculations, spreadsheets, communications, state-of-the-art computing hardware. When we did some work for Goldman Sachs in mid-90s, something like that, they had a supercomputer on the dealing floor, both in London and New York. Then regulatory changes: Basel I, II, and 2.5, and 3, and 3.5, and so on and so on. I mean, so they'll just go on. Not clear they're the right thing, but there's certainly been lots of regulatory changes, and there are, of course, a huge amount since the crisis. But there have also been changing product paradigms. What are securities were supposed to be just that. Stocks and bonds were where you stored wealth, however meager or great, and you know, you expected to get a return on that at least kept up with inflation, and that's what it was, a store of wealth, so to speak. But now there are all kinds of different financial product paradigms. Risk transfer comes from derivatives. Transferring property, exchanging contractual obligations of all kinds. And this led really to the exponential growth of over-the-counter structured products. Now, they're over-the-counter products, OTC products, which is mainly what Darren was talking about, and also in the discussion in the previous week, or whenever it was, a couple of weeks before that, there was a chap here from the exchange that handles 80% of these derivatives, and he was saying that basically they're standard vanilla fixed floating rates derivatives. They don't handle what I'm going to talk to you about, structured products. So financial services therefore began to trade, and the emphasis shifted from customer benefit to shareholder benefit. There were profits in the complexity of the instruments that were sold to the general public, so to speak. Not too general, mind you, until relatively recently anyway. And they were used properly, as Bob Merton always says, for risk management. Everyone's better off, and to hedge, to try to control losses. This led to the idea that your returns on capital should be risk adjusted. And however, due to global lax regulation, banks ever increasing leverage, and there was a lot of talk in this season already about leverage requirements, leverage in general, how it's going up and down, and so on and so on. But what's been happening is that counterparty assets have been used to preserve banks. I mean, I'm not talking necessarily about repos, but you could argue that that's what the repo market does. And really, the derivatives to preserve banks' regulatory capital. Now, clients buy them. Why? Well, because they want to optimize interest rate and foreign exchange liabilities, because now it's a global world. Most corporations of any size, even small ones like our own little consulting firm, deal internationally. So you have payments in different currencies, and if you're big enough, you're going to want to hedge those. And then you want to hedge default risk, credit. And these led to credit derivatives, credit default swaps, and collateralized debt obligations, which grew out of hand, so to speak. And then also there's a lot of derivative trading that is really trying to profit from tax arbitrage. Cross-border leasing agreements and things like that of property. This is widespread in Europe, North America, at least. This, however, this growth over this period has led to a giant number of financial crises. Now, I'm not going to run through these. The whole point of this is that there are a lot of them, and they're very regular. The only thing I want to draw attention to is that I believe, along with a sizable but not majority, sizable minority, that there's going to be a crash in China sometime before the end of this decade. When? Who knows? don't want to bet short, they'll outlast you, especially with a command economy. And every time before these crises, the dot-com bubble in 2000, and which broke in 2000, is the perfect example. This time it's different. But financial crises have marked the development of capitalism since the Renaissance. And as Reinert and Rogart in their relatively recent book pointed out, these have almost always been connected with sovereign credit. The current Eurozone crisis is, of course, to do with sovereign credit too, except the sovereign now is a democratically elected government and not a king or a prince, but same problem. If you really want to understand this, you must read the latest edition of Kindleberger's book. He gives a detailed account of financial crises in Europe and North America from 1618. He has a model. I mean, I don't mean a mathematical model. He has a conceptual model that you could fit into any one of these crises. He's distilled it from careful study. Unfortunately, he's no longer with us, but his book is absolutely brilliant. This time is different. But the only thing really that's changed is presidential rhetoric since the 29 crisis and the 2007-8 crisis. In 1933, Franklin Delano Roosevelt said, "We've nothing to fear but fear itself." In September of 2008, the president said, "This sucker could go down." And indeed it did. So let's turn now to the role of structured over-the-counter derivatives. Here are some views on the role of derivatives that have been widely expressed. Not least quants have kind of turned to the US National Rifle Association saying, guns don't kill people, people kill people. In other words, it's not the derivatives, it's how they're used. And there's a lot of truth in that. On the other hand, there has to be a lot of complicity in actually designing the instrument from people such as ourselves. So that's the jury's out on that. Warren Buffett's famously quoted as saying, "Derivatives are weapons of mass destruction." He ought to know. He sells them both before, during, and after the crisis in huge volumes. And he gave, what, $6 billion to Goldman Sachs when they really needed it in 2008? No, I guess it was early 2009. Now, when I got into this in 2007, when our group got into this in 2007, I told someone who was at that time a managing director, senior managing director of a big UK bank, dealing in derivatives, of course. And he said, "Well, don't you understand, Michael, there are two types of derivatives, those that are bought and those that are sold, in proportion about 30 to 70%. We'll come back to understand what he meant later on. But I like to point out to people that banking is actually the last major industry to go high-tech. Started with the military in the Second World War, then aerospace, then oil, then manufacturing, then airlines, then logistics, filmmaking even. In the late 70s, early 80s, the entire computer science department of Berkeley was working for Lucas and Lucasfilms to do computer-generated animation. And that was long before banking got technical, so to speak. Now, let's just look at the swap market. This is a slide from, I think, an MBA course that I used to teach, which was how swaps worked in the early days. And this was what Bob Merton was really referring to. I mean, with a swap dealer standing between two companies, one who could borrow at a floating rate cheaper than a fixed rate, and the other way around, the swap dealer could go in between the two, change the two cash flows, exchange the two cash flows, everybody be made better off, even after a reasonable margin for the swap dealer. That was the deal. It's perfectly sensible. But it was, of course, an over-the-counter product. It was specific. How did it go? Well, it began in the early 70s. It was IBM World Bank swap. That was the very first one. Before that, there were swaps, but they took 400 pages of legal documentation, and by the time they were done, it was sort of too late. They weren't going to spend. But this one was the first one that was done not by parallel back-to-back loans, so to speak. And then what made it take off was ISDA, the International Swap Dealers Association, it used to be called. And now it's called the Swap and Derivatives Association, I think. Formed in 1985. They had a master swap agreement and the thing took off. And of course, this led to capital adequacy in the first Basel Accord in '87, and then risk measurement in 1993, and in Basel II.5 in the US in the late 90s. Exponential growth. By the end of 1997, when they were about to bring down the Glass-Steagall Act, at least it was in the wind, there were 17 trillion notional in fixed floating swaps. Now, that is as of the end of last year, which is what we have at the moment, released by the Bank of International Settlements this past June, 585 trillion. I think it's amusing to note that that is almost exactly double the square of 17 trillion. So that's called exponential growth, effectively. Well, it's quadratic growth, I suppose, really, to be precise. So what's the current state of derivatives dealing? Well, I mean, after the crisis, certainly their use has been both good and bad. And over the past 2 decades, both fixed income, first of all in this exponential growth, and then in the late 90s, early 2000s, we saw exactly the same growth in CDSs, CDOs, and so on. And the uses have been both good and bad, of course. The asset-backed securities markets are reviving at the moment. Indeed, they're being backed by central banks, both in Europe, this country, and the US. And,
Schäuble suddenly.
Yes, exactly. Especially Germany, they're very keen on this now. Absolutely right. The cash CDO market, which was, I think, a scam, it was very similar to, it was very similar to what happened in the '29 crisis when there were all these subsidiaries of investment firms that were trading with each other to pump up the stock price and so on and so on. And that's sort of what cash CDOs were in my mind anyway. The synthetic CDO market is still there. It's declined. Vanilla swaps, fixed floating, standard, like I showed you more or less, but now just between 2 counterparties. And CDS contracts are being moved to cleared exchanges, but we'll come back to that. And over-the-counter contracts are being severely regulated more and more, and I think that is correct. I think it's still got a long way to go. This will lead to substantial reductions in dealing profits, and by the end of this talk, I will show you, some numbers. Let's get some numbers going up to the crisis or just after the crisis. I mean, it is really hard to believe that derivative notional at that point was around 600 trillion. The global GDP was about 60 trillion. It's still about, the derivatives are rising now in notional, and it's still about 10 times global GDP in notional. Well, mark-to-market we'll come back to later. Debt and asset-backed securities is 77 trillion, is like 10% of this total of, quote, assets. Broad money, that is, deposit accounts and all this kind of thing, and money in circulation amounts to a glorious 10% of the world's currencies. And banks, bank accounts, so to speak. The interesting thing is that in spite of the collapse of Lehman's, actually, yes, the total notional went down for a bit, and then it went back up again. It's now up there, as I will show you with some numbers up to date later on. In fact, here are, I want to show you 2 of these. The new format from the BIS is really hard to fit on a slide. That's why I have outlined these in red. You see there in the first half of 2013, you see there were 692,900 trillion. So 693 trillion in notional. On the other hand, mark-to-market, there was at the same time 27.3 trillion. And on the other hand, and this is something I learned the proper interpretation of, although I still think my interpretation I'm going to try and sell to you is correct, from Daryl a couple of weeks ago, or was it last week? It was last week, yeah. this called gross credit exposure is suppose nobody pays back the instruments in the market. They just all die. How much is lost? This shows you that there's a huge amount. One thing it shows you immediately is that there's a huge amount of netting. The mark-to-market, for example, here in at the end of 2011 was 23.3 trillion, 27.3 trillion, and yet if everybody didn't pay anything at all, there'd be about 2 trillion lost. Which shows you that most of this is inter-agent trading, and that given the various accounting between the US and the international accounting standards and so on, derivatives are accounted for differently on banks' books, and I'll show you Barclays a couple of years ago, later on. And so these things, and the BIS says this, first of all, they don't necessarily get everything. That was a point that Darren made from more knowledge than I have of this. So if everybody just stopped paying, everything was canceled immediately, either by, the world collapsing or something. There would be about, at least at the end of the first half of last year, about 5.43% of global GDP. And here's a similar thing that came from The Economist relatively recently in May. This shows you just the top line of that notional, and you see it is around the 700 trillion mark. On the other hand, corporate bonds have sunk and never really come back after the crisis. So whose risk is actually being covered by these derivatives? That's the question I want to address. They should hedge bank interest rate and foreign exchange strategies with swaps, but that's between banks, not with clients of banks, so to speak. They also could manage counterparty risk with cross-border leasing deals, incorporating credit default swaps and all this sort of thing. And collateralized debt obligations, it's not too clear who is being insured there it's when they're sold in the retail market, which in retail in quotes, they actually work. And then there are lots of, and I'm going to show you some cases of essentially playing poker against the clients. So, for example, swaps will have issuers' cancellation rights, which means that if the market moves against the issuer, they can cancel with no, that's it, the deal's dead. On the other hand, if it moves against the client, they just have to pay more, so to speak. And CDOs, well, there's been a lot of stuff about that, indeed, in the courts in the US about substitution rights, substituting reasonable mortgages with of subprime and subprime and fictitious ones and everything else. But so naturally economists and therefore financial economists would like to think, and certainly the judiciary in most countries would like to think that, this is a market. And therefore, the market will determine the price, and that's perfectly reasonable. But of course it isn't, as Darren explained last week. Structured derivatives lead to problems which are not directly comparable with normal commodities. And pricing these complex deals is beyond the scope of anyone other than other investment banks or really big corporations like the oil companies, the big manufacturers like Siemens and, I don't know who all else, General Motors and so on and so on. And that's a rather small number of players in all this, although the banks, of course, are big. But as I say, it all sort of comes to very little, relatively. So this has been recognized sort of in both regulations and legally, that the division of clients into retail, professional, and eligible counterparties, and the idea of complex and non-complex instruments, these are now in MiFID for Europe and Dodd-Frank for the US. What is complex, what is not? But it's, like all these things in this kind of regulation, the boundaries are rather fuzzy, so people who shouldn't be said to be professional are, and the banks will argue, oh, they should know what they're doing. The fact is that they don't, and the bank knows that. And these implications have not really been adequately recognized by the courts anywhere, but I would say that Germany is the most advanced in this field at the moment. Okay, now we're going to get into what the cost of these things actually are to clients. So we're going to revisit the idea of caveat emptor, or let the buyer beware. So I'm now going to explain what the MD told me. It's been said that 30% of OTC derivatives are bought and 70% are sold. Recently he changed banks to a European bank actually, and revised it to 20 versus 80. Now what he means is that only 30% of deals are between counterparties who are professionally able to assess the risks. In other words, another bank or a big corporation. While 70% involve counterparties who have no idea what they're buying. Now this is in terms of deals, so it doesn't necessarily represent value, but it represents lots of activity. It represents rewards, at least, for the people who are dealing. And a rule of thumb which we learned early on is that a counterparty should never accept a restructuring of a losing deal. It's like, playing poker when you're, or playing any card game for money. When you're down, you should fold, and that's it. But people don't want to do that, and they just get more and more, get worse and worse. So our involvement in this began, first of all, with deals that were issued in 2004, 2006. That was in 2007. That was in the boom period, of course, through to the crisis, and with present deals issued last year and this. I mean, we're working on deals that were issued last year, about less than a year ago. Clients are governments, a prime target, second-tier banks, small and medium enterprises, local authorities, and wealthy individuals in Europe and the UK. I used to say no local authorities in the UK, but I learned on Monday, and I'm going to show you, that isn't true, because there's a trick. To allow, it's illegal for a local authority to deal with to take out a derivative contract with a bank in this country. So that is a derivative contract, of course, covered by an ISDA agreement. So they've found a way around that, and I'll explain that to you later on. So the contracts involve everything: swaps, bonds, foreign exchange, all mixed together, and so on and so on. It's a challenge to price these things, I have to say, and sometimes it runs a lot. We don't have, absolute fantastic machinery, but actually to do it properly, we're now probably going to have to move to the cloud sooner or later. But we have good machinery, and it sometimes takes quite a long time to calibrate these things, because of course we're not an investment bank. Now, the representation of the risks is typically stated as unlimited, or it ignores the egregious features of the contract structuring, like one-sided cancellation options without compensation to the client, the counterparty. We have a paper published in the Journal of Banking Regulation on this early experience. And we're working on one that's basically based on these slides. Now, some stylized features. Each deal represents a play by the issuing bank that exploits, and I'm going to convince you of that with a whole lot of pictures, that exploits their superior knowledge of possible future market evolution relative to the clients. The clients don't have a clue about how the financial markets are actually, what's their momentum, so to speak, in which direction, and everything else. The traders, of course, do. The issuers are usually in the client's commercial bank, and the term sheets and contracts are usually bear a feminine bank signature. That is just a fact we have observed. But when you think about it, most of the people who in local authorities and Mittelstand companies in Germany and middle-sized companies in this country and so on are run by relatively middle-aged or elderly men. And if you send a very smart, good-looking young woman to convince them they ought to buy a derivative, that's going to be a better sell than if you send, another clunky guy, right? I mean, but it's a fact that almost all the term sheets we saw in Italy and Germany anyway have a feminine signature. And in this country too, actually. Not the complete majority. Well, the majority here, but not the complete. Okay, so often there's sort of coercion. You want the loan, you want to roll over your loan, you want to refinance. Okay, you have to buy this derivative which will protect you. will hedge your losses or reduce your interest payments or something. And each deal always has, I mean, you know, P.T. Barnum would love it. I mean, the enticement of some short-term client sweetener. This works particularly well with local authorities. Oh, you just borrowed 1.8 billion euros? Well, and you're paying what? 4%? Well, look, we can reduce that to 2%. They don't say that that's only for 2 years and it's a 30-year loan. And after that, it all goes to hell. That's exactly what they did to Milano, and they lost. Actually, Darren worked on that too, and he worked with one of my former students that we learned last week. They lost actually a little short of about €500 billion, something like that. Yeah, I mean, they lost really a lot of money. I mean, no, sorry, I'm sorry, €500 million. Yeah. And they ostensibly got it back, but not really. That's another story. So there's always this sweetener, and that's very important. And often it's not done in one contract. It's a whole series of them. I'll show you one of those. And due to the asymmetry of information, the client's in no position to understand the relative risk to the client and the bank. When a deal goes wrong, the bank offers the client to postpone the agony by restructuring the deal, which again, you know, makes things better for short term and then gets even worse than the original one. Okay, well, here's the idea of a par swap, which is what's going on in the exchanges, and you know, it's a substantial. LCH ClearNet is now doing what, 80% of them we heard a couple weeks ago. After a reasonable dealer's fee, it's a bet, basically, on fixed versus floating rates. If there's a cancellation option, this is the losses to the client, these are the losses to the bank. Then if there's a one-sided cancellation option, then this pulls in the bank's tail and lengthens the tail of the client. And if there's some more structuring, it can get even worse. I'm going to show you some real pictures now in a minute. Now here's the first kind of thing that we looked at, a so-called constant maturity swap, spread ladder swap. Constant maturity swaps are a market, of course. You can, you know, these are the trouble with well, basically the swap market is so deep that one can get almost instantaneously the current price for a given swap. So here's the sweetener part. You see, this is what the client gets from the bank. It's just a fixed 1.5%. This will be quarterly, I think, and then it will pay for 2 periods. In this one, you know, half that. So it's making 75 basis points for the first 2 interest payments. After that, there's a floating rate that takes the last payment, the previous payment. In this case, it'll be the 75 basis points. And then there will be some complex thing here. This isn't necessarily the right thing, but it gives you the right idea. There's some kind of fixed part, and then there's something that is variable that's going to change with the market. And here's the first type play we saw, was the flattening of the yield curve. As rates rose in the period, first of all in the States, it was in 2004, 5. In Europe, it was 2005 and 6. Short rates were rising, yield curve flattening. So what do you look at? You look at the difference between the constant maturity swap 10-year rate and the constant maturity 2-year rate, and you make that structured part work on that spread, which was coming down. And they could see it was coming down. See how it came down from 2004, this is in Europe, all the way down. So here's the result. Here's a real one. You see, 4 nice payments, positive to the client, then the expected payments here, 1 standard deviation down, 1 standard deviation, oh, I forgot there's a cap in this one. So that's where the cancellation comes in. If the market goes that far, they just cancel. That's it. Actually, there was a cap built in as well. Now, what does that look like in net present value? Well, I'm sorry these don't come out too well, but you see there's the green one. That's the actual one. This is the one without the one-sided cancellation option. And you see the tail is long. So we look at a 99% value at risk for this net present value distribution. Sorry, let me come back to this. Okay, now, as time goes on, it just gets worse. The tail's getting bigger, the part that the bank might lose is getting smaller, and so on and so on. You don't have to play this with derivatives. You can play it with structured coupons on bonds. You borrow money, the bank, of course, for its capital, and then you structure the coupon payments, the idea being that they should sink, so that eventually you've got the money and the investor doesn't have much. And of course, for Tier 1 capital, these were perpetual bonds even. And so you just keep the money forever, and they get very... And interestingly enough, the first one we found was issued by the European Bank for Reconstruction and Development, which should hardly be in this game. And their coupon went within about 10 years to zero, literally. Here's one, if there's no floor. That previous one had a floor at 3%. This one had no floor, and so within one standard deviation, you can get down in a few years to zip for coupon payments. And here's the cash flows. Now they're around 1, not 0, because that's face value. But you see the same idea. And this one I want to go fairly quickly on, but this is the first one we saw that was really structured. There were 70 option pairs exchanged between a bank and a client that was a big travel agent in Germany, and commercial travel agent. So they needed lots of dollars to send people to the US and South America and Russia and so on and so on. And they were doing this with forward contracts, and they noticed that every so often they lost something. And so, and someone told them, well, you'll do better with options. And that was probably true, except that, of course, then the bank said, oh, but you have to pay for these up front. And they, whoa, wait a minute. I mean, you know, we're used to just signing a contract and then we see whether we won or lost when we need the money, so to speak. And so they said, oh, well, we've got a deal for you. We'll exchange option pairs, and they will be priced the same at inception. And then, you know, depending on what happens, you might lose, we might lose. Everything's fine. Well, they had a whole program of these. In the first instance, a lot of them deliberately, I feel, you know, expired out of the money for anybody. And then sometimes the client won a little bit. The little bit over, what, over 33 months at the beginning, say the first 10 months or so, or even the first 20 months or so, you know, the little bit amounted to about a half a million euros to the client. That was the sweetener. And then on just when Deutsche Bank, I shouldn't have said that, needed the money in February 2008, they sent them a bill for 30.5 million. Noticing it's 30 million, but they got back their $500,000 as well, actually. And actually the treasurer of the firm paid the next day the money. It wiped out their profit for a year, but he said, and his communication to them said, and by the way, you're no longer our commercial bank, not surprisingly. So that was that. And so this was a play on the rise of the US dollar European exchange rate. The pair of options, the payouts looked like this. For every penny that moved in the bank's favor, they got a couple, or they started off with, they got 4 pennies, and when it moved the penny in the client's favor, they got the penny. Later on, they got 6 pennies. That was on the restructuring. And the worst thing is this, that actually they mispriced all the clients' options in the first place. They overpriced them to balance the actual market value of their options. And on average, that was a 36% increase in the market value of the client's options. So it was a pretty evil deal, shall we say. Now, I want to show you very quickly just some pictures to give you these ideas. I mean, we've seen a whole lot of plays. I showed you the play on the flattening yield curve. I showed you the play on the US dollar euro exchange rate. Now, there are just a whole lot of pictures of things. I mentioned before the requiring of these things on loans. This is in the UK, and there were slightly more sophisticated clients. If they said, oh, wait a minute, this doesn't look right. So they said, okay, well, we've got a more complex deal, and they were actually worse. When the rates dropped, they raised the interest rates once a floor had been passed and things like this. There were ones on strengthening of the Swiss franc, on the lowering of the CMS 10 rate due to quantitative easing, the weakening of the Japanese yen US dollar exchange rate most recently, but before it was on the strengthening of the rate. So the direction doesn't matter, the bank just has to know it, that's all. So here's the Euro Stoxx 50. Here was a company that lost 7 million of a 10 million 8-month investment on that drop. Now the bank saw the drop before in the Euro Stoxx 50. That's the dot-com bubble bursting. So they knew full well when this thing was issued that it was going to go like that, and they made a lot of money on it. Here, it was all about the base rate dropping when finally the Bank of England got around to following the rest of the world's central banks. To model that, we had to actually use something that's market observable, so we used a short rate, and that's what the red is there. Then more recently, we've done ones. This involves 3 currencies, and therefore really 3 cost currency rates and 3 yield curves and so on. So it's a lot. And then recently Euro Swiss franc, I mentioned that. And just to show you some deals, here's a net present value actually computed, and you see 0 is right there, and the client can lose up to about 4 million. Oh no, that's a fraction, 40%. This is one that Bruno de Peer showed at Global Derivatives in May, when he made the following statement. We all know that derivatives are about money up front and reducing regulatory capital. There was a bit of a gasp at that, but everybody knew it. And this was a bet on the 3-month Euribor rate going down. And he claimed that this was the worst trade of all time. It was Santander Bank and like streetcar firm in Portugal. On 89 million, there was a current mark-to-market of 459 million lost, relative to a notional of 89 million. So let's say that's 90. So that's 5. The current mark-to-market is 5 times the notional of the derivative. But I would argue we've done even worse than that. It was on a CMS 10 rate evolution. It was in Germany. You see that just in that case, in that previous case, 40% of notional was the current payment. In this one, 30% of notional is the current payment. You see there it's minus 3 million. You see, out near the end. But it had been going longer, and here's the story. There, you see, there's virtually no upside whatsoever for the client, and they have some possibility of losing up to 600 million on a 10 million notional. That's pretty bad. Then we've seen Japanese US dollar. I mentioned that before. You see here, we saw some derivatives in this period betting on the strengthening of the Japanese yen against the dollar, and here now the weakening with Abe's Abenomics, so to speak. And this is the most evil, up-to-date thing. This is one that, well, I don't know the outcome. There was a negotiation with the bank involved in Edinburgh yesterday. We actually divined what was going on. So the deal is, and this is not just that particular bank, which really is the major commercial bank in the north of England and Scotland. All kinds of companies, including our little firm, have to borrow from the bank, buy something, building, whatever, equipment. at fixed rates. And therefore, if you've been in business for a while, you're very used to rolling things over, and you typically have to pay 1% of the outstanding debt, 3 interest payments, or something like that. However, suppose the bank did the following. They simply, Bank B, suppose that they just passed the fixed rate payments through the swap market to another counterparty. And the counterparty pays them floating. And that's the story. Now, if it's in that period that I showed you, when the bank rate dropped from, I can't remember what the top was, 4 or 5% down to, well, 50 basis points it was for a long time, lower than that now, then of course that would be massively in the favor of the counterparty. And therefore, for the bank to, if for the client to roll over the loan, to cancel the loan, he would have to pay, or she would have to pay, you know, whatever the market price of the swap was that was way out of the money for the issuing bank. And that amounted usually to about anything from 15 to 45%, depending on the market at the time, of the loan value. Well, needless to say, another bank wasn't going to roll over the loan because most of the money, or at least a substantial portion of the money, would be going to another bank. So they didn't want that, so nobody did it. And so there are 60,000 firms. There are 40,000 firms have been missold, essentially, which is now more or less admitted, but nothing's been done about it in this country. Overlaid swaps on loans. But there's 60,000 with these embedded things. Now, what we've discovered, our team trying to analyze this, is that actually there was no hedge like this. They just agreed, I think, with other banks, but we can't prove that they would just charge people for these kinds of loans. That number. Market observable, it's on a screen all the time, right? I mean, so you just say, oh, you want to break it? Here's what it costs you. And we had clients where, you know, we've seen how as the market goes up and down, this proportion of notional goes up and down, as it would, because it is actually the mark-to-market of a fictitious swap. Worse than that, we found that the bank didn't even hedge the book of these things, which is huge. The credit protection alone, which was on top of the, you know, the ordinary finance, amounted for the book in Scotland to 1.8 billion pounds, which has drifted back to another country. And will never come back, of course. And I thought that was it. This is, you know, small and medium enterprises. However, on Monday, I learned the following. This game has been worked with local authorities. Now, you remember I told you that in this country, local authorities are banned from doing derivative deals. But these aren't derivative deals. The whole point is, there's no ISDA contract. They're just built in. And here, for example, Liverpool, we learned, has borrowed 170 million of these things before the crisis. Still running because local authorities buy 30, 40 year, I mean, they arrange loans 30, 40 years in maturity. This one was bought from RBS. This is public information. That's what they said they would have to pay. You see, they can borrow from a government agency at, you know, some spread over prime rate for the maturity. That is, you know, the gilt rate for the maturity. And UK government bonds over the maturity. So there it is in this one that was done 2 years ago. No, actually 3 years ago, roughly speaking. Actually, almost exactly. No, it's 5 years ago, I'm sorry. But it's still going very badly because this is what they've paid. Instead of paying this is what the bank told them they would pay, and they would still be below the rate they could borrow from the government agency, which was the whole idea. But it had a floating structure like the kind I showed you, and they've been paying, you know, 6.5 and 6, and it's going up at the moment, and so on and so on. So local taxpayers in London, in Brent Borough, are up in arms, not surprisingly. Okay, so let's summarize this, and then in the last 10 minutes or so, I'll try and show you some other things related to this. So I summarize it as follows. These products are invariably mispriced in favor of the bank at inception, and they get worse over time. And really, it's like going to the track, having fixed a horse race. You don't know you're absolutely going to win, and there's always some upside for the client, but it's very, very small. If the market makes an extreme movement, it's possible they might, break even or a little better. But, you're not absolutely guaranteed to win the fixed race either, because, the horse can stumble, the jockey can fall off, and whatever. But you surely have an edge on the people who are betting on the race if it's been fixed. So I'll go very quickly through some pricing methodology, because this is the work in progress part that I mentioned. I mean, we have been using for all this work a three-factor interest rate model. We've fitted it to almost every jurisdiction at different frequencies from daily to quarterly. We've priced consul bonds on the grounds that on 256 years of daily forward simulation, on the grounds that at that point the cash flow is just wiped out by discounting. It has a wonderful provenance, this. It came from long-term capital through layman's to us, actually. It's a Gaussian model. It's fully identified. It doesn't have some of the things that you'd like to have in it. It does have a varying prices of risk, because they depend on well, this allows you to identify it, actually. So some things are constants which probably shouldn't have been, and I'll show you some results quickly that are not, but it's a workhorse, and it's done everything we want. It's relatively easy to calibrate. We do it by actually dealing with the swap curve, then backing out the yield curve, and then we calibrate the model using the EM algorithm with Kalman filtering and maximum likelihood estimation. And of course, you need an optimization there, and we parallelize it on our internal system and so on. And we're experimenting anyway with cloud computing for these kinds of calculations. It works pretty well. This is a fit. We work on historical data. We calibrate to historical data. I've always argued that will give you a better dynamic forward than just pricing on today's yield curve and then taking the consequences. But of course we fit it to the day's yield curve, and that works pretty well. Well, this is the details of how we actually price. I think I can skip that. The point is that it predicts pretty well, and we had actually a test ordered by a German court of its predictive ability, and to our great comfort, I wouldn't say dismay, it actually predicts better than the standard Nelson arbitrage-free Nelson-Siegel model of Diebold et al. That's used widely in central banks, three-factor yield curve model. And it's also quite good, it fits. It also fits standard deviation rates as well, quite well. Now, what are we trying to do with it now? Well, the point is that in a low rate environment, Gaussian models aren't going to work, because there's too much probability on negative rates, which don't exist. These are, they're not real rates. These are nominal rates. So Black had a brilliant idea, which is, let's just apply, sort of the hockey stick function to a shadow rate that's based on your favorite three-factor yield curve model, and then that will make all the rates positive. And this has been a whole industry in the last few years. It was started, not surprisingly, by the Bank of Japan econometric team. It then spread to the Fed team, particularly in the West, San Francisco, and in Washington too. And you see these names are all quite well known if you know something about financial econometrics. And we started doing it with a client. The client is up and running, and it works pretty well. There, for example, is a 10-year gilt rate predicted 50 years ahead from 2011 to 2061, and it's true, there certainly are no negative rates. And if you're going to do long-term investment, asset liability management for insurance or pension funds or something, this is of course something that you want. You want the long term. Of course you don't, if you're trading this stuff, you don't care, because you just fit it to today's curve as best you can with smiles and everything else, and then tomorrow, well, it's all set up, it just runs. unless it really goes badly. So, well, I'll skip this. I mean, this black model has all the properties you actually want. The problem is, I should go back there, the problem is no closed form bond prices. So you're going to have to do some computing. And our client actually did it by Monte Carlo using cloud computing. And they only fit 4 yield curve points against our advice, but that's what they did. So you can do it by Monte Carlo. You can do it by solving bond pricing. This is what the Kim and Singleton papers, the Stanford papers, are really about. Most recently, Alex Lipton has shown that, that ADI methods don't work too well in the 3D case. That's now it's coming out in January, Quantitative Finance. It's not, he's working on derivatives with stochastic volatility or mixed stochastic and local volatility models, but they're solved by PDEs, and so he has some very, very interesting results in this paper. It's really more of a survey than anything else. Of course, they have a new technique. And we're actually collaborating with numerical algorithms group on something that, on a 3D PDE solver based on wavelet discretization, essentially, wavelet irregular mesh. And it's being recoded now to go in the NAG library because it's hard to get a robust 3D PDE solver. But I think in the end, that's not what we're going to do. What we're going to do is go to the unscented Kalman filter and do what we've always done that will deal with that so-called hockey stick nonlinearity. And then the thing about the unscented Kalman filter is you actually do an ordinary Kalman filter in different places, more or less. That's the idea. And you have to do a bunch of those. They can be mindlessly parallelized, however, so you can do it in about the same running time. That's what we're working on. We're hoping to finish this by the end of the year. Okay, let me finish up on what's happened to regulation. Okay, so why do clients sign these over-the-counter contracts, these evil deals, or toxic deals that I've shown you? And there are more of them, and they're coming new ones every day, more or less. Not as many as there were, but they're coming, nevertheless. So, I really don't have to say this. I mean, those of you who heard Darrell Duffy last week will know that this is basically microeconomics based on random search, rational risk-neutral investors, and the central limit theorem, and that does it. And he didn't mention that he has an extremely nice book on what he talked about last week that was published about 2 years ago, something like that. Or maybe even last year, I don't remember. I looked at the book, and this is what I concluded from it. And he showed us that elegantly last week. However, the paper that I like is the one that appeared in the behavioral finance special issue of the journal that I edit last April by Torsten Hens of Zurich. And it's brilliant. It's only about a 6 or 8 page paper. But what it shows is the following, that structured investment products offer, oops, what happened?
Sometimes does happen.
Oh, does it?
Yeah.
Oh, is there somebody who can unhappen it?
Sometimes comes back as mysteriously as it went.
Ah. Yes. It did. Okay, good. Okay, so what he showed in this little paper with Rieger is that there's really no gain after fees in these products. Now, these are relatively fair products, but they're still, over-the-counter products, so to speak. They're structured. And however, what he shows is that using behavioral finance, if you allow investors to misestimate the outcome likelihoods by overweighting favorable relative to unfavorable outcomes, not like the diagrams I showed you, the net present value diagrams, then of course they look like they should be bought. And I think that's what's going on to a certain extent. So that's sort of theory of gullibility. So we have ranked all the ones that we've done and we know about because we've been collaborating with Bloomberg News, particularly in the case of Italian local governments and the Italian government and the Monte de Paschi de Siena Bank and so on, who did derivative deals with a couple of, well, one Japanese and one German bank. And these are some of the losses, and I've tried to classify them. So first of all, there's desperation. I mean, if a city manager like in Detroit signed all these contracts with Goldman Sachs, why? Because he got some money up front and he needed it. Okay? Then there's coercion. This is widespread with small and medium enterprises. You want that loan, you want to roll that loan, okay, it's going to cost you. You have to, but actually that's not what they say. They say, okay, you have to have this derivative, which is going to, yeah, I know, yeah. So, which will cover your problems. Then there's trust. That's the one that changed the whole situation in Germany, where basically the commercial bank, which was Deutsche Bank, sold a derivative to a company, a Mittelstand company, and they eventually they were so hopping mad about it that they took it through 3 layers of court and they actually won. And then there's gullibility. The German Landesbanken bought all kinds of credit derivatives, the Austrian National Railways, number of cities in Italy. And then there's complicity where, you know, for example, the Italian and the Greek governments to get into the Eurozone just did derivative deals to make things work out. So, of course, this is...
I'm afraid we're running very low on time. It's 3:02. I think there's another seminar.
Oh, is there? Okay. Well, so this is trying to be addressed, but I don't think well with both Dodd-Frank, Consumer, MiFID, Basel III, et cetera, et cetera. I think if they showed the pictures that we showed on term sheets, no one would sign these deals. And there's one point here that just to say that that's the amount of vanilla ones that are being cleared. It's not much over a third at the moment. Balance sheet of Barclays huge relative to the UK's GDP. And this is the last slide. The top 20 derivatives dealers have a lot of money in this game. And I think that actually we can make an argument that says that this 3 trillion, you see it's come down, the notional's come out, the mark-to-market, the notional's gone up, the mark-to-market has come down. This is the end of last year, the latest figures. And so has this gross credit exposure if nobody pays anything. But I think that one could argue that since these are all hedged interbank, all this stuff, that this is actually what's coming out of the real world, and it's about 5% of global GDP. So on that, I'll thank you very much for your attention. And there's
questions
Yeah.
offline because we've run low on time and
Yeah.
there's another grouping, but thanks for the.
well, we can.
It's nice to go through the last 3 slides in more detail, if it were possible somehow, because that's getting to the nub of the matter, the interesting part.
It is, but I mean, you can see the slides, so there's no real problem with that. I can send them to you if you want.
Yeah, I'm going to.
They will be on the internet?
Yeah, they'll be. I think they'll be on. I think I signed something that said they would be. Yeah. Okay.
Great,
Thanks very much.